Welcome back, everybody. Tuesday night and Vetted VA Live. I am Josh Lewis, certified mortgage consultant and vetted pro here in California. We get here every Tuesday, and I get a group of pros, real estate and mortgage professionals who have been through the Vetted VA vetting process to answer your questions and moderate in the Vetted VA Facebook group. But we come here every Tuesday to answer your questions live and go through a topic in depth. And tonight is a good one. It's an interesting one. For those of you who've used your VA benefit to purchase a home before, you're probably going to say, well, that's very basic. I've been through it. But many of the veterans using their benefit for the first time are first-time buyers. And there are a lot of misconceptions around, hey, this is a zero-down loan program. Why do I have to have cash? Why am I getting asked for a deposit by my realtor? So we're going to go through everything, what you need, when you need it, alternatives for coming up with cash. Is there a way to do it with no cash at all? We're going to go through all of that stuff. So our pros joining us tonight, Stephanie Safholm, a mortgage loan originator from the great state of Hawaii, Randy Tikal, one of our regular guests here from Salina, Texas, and Gary Foote is a realtor that covers both the Los Angeles and Tennessee markets. And he's going to have some really good content and going to walk us through, in the context of this, as a veteran needing to be prepared for some money potentially at closing, the NAR settlement and the possibility that some sellers may not be willing to pay a buyer's agent. So we're going to jump in and go through all of that stuff. But why don't we kick it off with you, Gary, and why don't you tell us or answer that obvious question that people love to ask the first time, where they say, why is my realtor asking me to write a deposit check or wire money over to escrow when I don't have to put any money down? Why am I making that deposit at the beginning of the process?
Awesome. Great question, Josh. So what Josh is talking about is referred to as the earnest money deposit, initial deposit, or EMD. Those are the same thing. We like to use a lot of different words and acronyms in real estate and loans, and they don't always mean the same thing. But so the purpose of that is essentially just to try to show the seller that you've got some skin in the game. And so the seller, when they're looking at different offers, they're saying, okay, does this particular buyer, they're saying that they're interested, that they'd like to purchase my home, but if there's a zero as an initial earnest money deposit, what happens if we get to a point and they remove all their contingencies and they get cold feet? My home's been off the market for the last 3 weeks. I've missed out on other people that I could have potentially sold to. And now this feels a little unfair because I trusted that this buyer was going to move forward in purchasing my home. And now here I am 3 weeks in and they're not buying it. I'm going to have to pay my mortgage again next month because I waited for them. All their inspections and everything else was good. So this is a raw deal for me. So what they're looking for is for some type of ability to have things made a little bit more whole in their situation. That earnest money deposit helps with that in the event that you get to a place where you start taking away any contingencies that you have. Up until that time that you take the contingency away, your earnest money is protected. But once you take those contingencies away, that's you saying, I have every intention of purchasing this home. And if I back out now, Mr. Seller or Miss Seller, then a portion of that earnest money could go towards you for the time that you allowed me to pursue the home. So that's why it's looked at as fairly important for the seller, because they want to have a little bit of assurance that if something goes south after those contingencies are removed, there might be an opportunity for them to recoup some of the costs that they've had to endure during this process.
So we're going to go over another question here in a minute that we in the group are always faced with veterans saying, no, I've never done that. It is always, we'll fill in the blank there. But in this situation, if a veteran says, well, wait, I bought before and I didn't make a deposit. They understood I was a veteran and I wasn't going to make a down payment. So is that earnest money deposit required? And is there a set amount? Is it set in stone? Is it $500? Is it $5,000? Is it a percentage of the sale price? And realizing that it varies by market, it varies by price point, but and let's maybe go around the horn. You guys, Randy can tell us about Texas and Stephanie can tell us about Hawaii, but the two markets you're in, Gary, California and Tennessee, what's common and what does that look like?
Sure, absolutely. No, there's not a set amount. So you hit the nail on the head as far as what's custom, to that area. So that's going to have a weighted portion of what you're going to do with that. So how weighted is that? You also want to look at what are the market conditions? Is this home particularly a hot home? And so is there a lot of competition on it, or is there not? So that's something that's going to be something to weigh in on as well. Because if you're looking at how do I make this the most competitive offer, then we want to say, okay, how can we ultimately make the seller feel the best? Like that's what that comes down to, right? That competitive offer is how do I make them feel well? So I've had some where we've put 0 down and we've gotten the home, not a problem. Like literally no earnest money, and we close the deal, not a problem. But I've had others where it's needed to be thousands and thousands of dollars because that was the market, that was the area, that was the home, that was the situation that we were in. So it's going to be very specific, not only by market, but it could be by home as well.
Perfect. Randy, in Texas, what's most common in, and maybe it varies by price point. With your typical buyer, what price point are you seeing in general? And give us a range, and maybe what are you seeing in terms of deposits?
Really, just the standard in Texas and all the markets is 1% of the purchase price. That's the standard. So that's not to say that all of them actually come in that way. I mean, I've seen them come in for $500, and I've seen a few that were 0. But obviously, those were worked out. That was negotiated by the realtor. They probably weren't homes that had been on the market for a weekend. They probably were homes that had been around for a bit, and so it goes in just what Gary was saying in that it's going to vary. But in general, 1% is it. And so if you don't want to draw attention to your offer, then you go less than 1%. That's going to draw some negative attention. You go over 1%, it's going to draw some positive attention to it. So in some ways, I see that as a negotiating tool, just making your offer stand out from others. I've had one recently that was 3% for earnest money. And their thought process was that that's probably about what it was going to take in the way of closing costs and escrows. So they were fine with putting it down at the beginning just to get the attention of the seller, and it was a negotiating tool that their buyer's agent used to get the attention of the listing agent. So.
Perfect. Stephanie, how's that match up with what you're seeing in Hawaii? And I think you're also approved in the state of Washington.
Yeah, so in Hawaii, yes, similar to what both of them had said. It really depends on that specific house. I think the homes that are really hot, that everybody wants, people are going to put a higher earnest money deposit. But often we see 500 to 1,000 as the EMD, and a lot of realtors and sellers are VA themselves, and they understand what that means, and they don't shy away from it. But super hot homes, yeah, 1% at least.
And I was going to say, a lot of times when we see those really small deposits, 500 or 1,000, they are veteran to veteran transactions. Yeah. And it's so the veteran knows, and there's sort of a code of honor that you're not worried. I don't need $20,000 in escrow to cover that. I was going to ask you guys this question, but I actually have a really good example that just came across my desk this afternoon. Talk about, okay, so I make a $10,000 deposit, but I'm doing 0 down and I'm getting seller lender credits to cover all my costs. I don't owe anything. So is that refundable? It is absolutely refundable. And I saw one of the craziest examples I've ever seen today. Randy, is down in your neck of the woods. Buyer in Texas, new construction. So he's getting a $30,000 credit from the builder. So on that side, he's got $30,000. And then his agent is a buddy of his, giving him a $9,000 credit. So he got $39,000 of credits. It is it was like an $830,000 purchase. And kind of smoke and mirrors with that lender credit, builder credit, because the builder owns the lender. So they're charging a bunch of points, way overcharging for it. So it actually ends up like a $10,000 credit, but on paper, it looks really, really good. But he had $31,000 of closing costs, $9,500 of prepaids. And you look at it, it's like 40 grand. Well, he's got $39,000 of credits. And he's looking, he goes, what does this mean cash to close? It says negative $32,000. Well, a builder doesn't operate on the honor system or the code, and they want a big deposit. So for that $800,000 house, he already made a deposit of $33,500, and his total closing costs were all covered. So he owed like $1,200. He was getting $32,500 $1,000 back. So you absolutely can get that back at closing. And what he did is showed the seller, hey, I am serious. Even though I'm not making a down payment, I have the money. I can cover my closing costs that don't exist. So very interesting situation there, but it's just a big example, an example with big numbers of how you can absolutely get the money back. And we're going to go through how you can use those credits. Stephanie, why don't you walk us through the next thing? So let's say you made that deposit, you make a $10,000 deposit and you're not making a down payment. Where is that money likely to go? And just kind of start with walking through closing costs. And then maybe Randy can walk us through what the prepaids are and how we have additional costs.
Okay. Well, first I wanted to also define closing costs, because you hear a lot of different words, right? You hear closing costs, cash to close, prepaids, all these different words, right? So we're referring to the terminology that we're going to see like on a loan estimate or a closing disclosure. So that's where I think our terminology today is going to come from. Closing costs are the costs, the third party costs and the lender costs and the origination fees that it's going to cost to do the loan, right? But then we have to have this number at the very bottom of the loan estimate called cash to close. So let's say you got lender credit or seller credit, it's going to offset the amount of cash you have to bring in at the end. So that very end cash to close is what you need at closing, right? Or let's say you had an earnest money deposit, right? That's also going to offset the final cash to close number. So it's really important that you understand the terminology you see on your loan estimate and your closing disclosure. And if you don't understand it, you really need to ask your loan officer. That's what they're there for. That's what their job is, to explain every part of that loan estimate and closing disclosure. Did you want me to talk about starting with box A?
Maybe just, we've done an entire episode. So if you're watching and you do want the 45-minute breakdown, we've gone in detail on it. But why don't you just buzz through the left side of the loan estimate and what should they be seeing there and what would they expect?
Okay. So when we're looking at our loan estimate, it's broken up into sections, right? So we're on page 2. We're talking about page 2, which has a list of all the fees. I'm going to skip page 1 because I like to actually go through every item I see with my clients. So on page 2, we're going to look at the top left, which is box A, what we call box A, and that is lender and origination fees. Now, this is the box that's going to be different between different lenders, right? And between different rates, for example. It's going to have things like points, if you're paying points, right, to bring the rate down. It's going to have processing fees, underwriting fees, lender origination fees, all of these different fees that the lender specifically will charge. And this box A can change between lenders. That's really important to know. Some things on the loan estimate, regardless of who you're using, it's going to be the same, right? Title fees are likely going to be the same regardless of who you're going to use. Appraisal fee, $900 for, like in Hawaii, for certain areas are going to be the same regardless of who you use. So it's really important to know which things are going to change between lenders and which things will stay the same. So box A will change between lenders. Box B are items that you can, things that you are going to have to pay for, right? Appraisal, flood fees, tax fees, those kind of things, right? Box C is going to be title fees, and those are things you can shop for, right? And although we say you're going to shop for them, usually a seller or buyer is going to have in the contract who you're going to use for title.
So right. Technically you already did. By the time you've got to that point,
yes.
By the time you got to your loan officer, if you're with Gary or you're a realtor,
yeah.
you did shop for it, but it's kind of been negotiated as part of that process. You didn't literally go out and shop, but oftentimes the sellers and the terms of the contract dictate it. So while we get that question, I know Randy, you do, Stephanie, you do. People look, well, this says I can shop for it. So can I shop around and try and get this cheaper? Say, well, not unless you want to break the terms of your contract where you already agreed we're using this settlement agent.
Yes. Does anybody want to add anything else about box A, the ABC?
Again, if someone really wants detail, we'll put a link down in the
Yeah.
description where you can get to that, because we did go super deep in detail on that.
Yeah.
But Randy, so we get through that left side of the loan estimate. That's not everything you got to pay. We get over to the right side, and we in the business make a distinction. Those aren't closing costs, but oftentimes buyers are like, "What are you talking about? At closing, I'm paying those. Those are closing costs." So maybe walk through the distinction of what shows up on the right side and what a buyer can expect.
Really, the section that we're talking about is called prepaids, and so the prepaid is things that you have to pay in advance, and primarily those are going to be the homeowners insurance. And homeowners insurance, you're going to pay a year's worth to start with. That's a prepaid, and then you're going to build an escrow account, typically of 3 months. So you're going to pay 15 months worth of homeowners insurance. And the reason being is you're going to pay for a year's coverage, but you're also going to be starting an escrow account that's collecting every month enough that when that renewal comes due 12 months down the road, there'll be enough in there to pay for the renewal on the homeowners insurance. So that's 15 months of basically prepaid. I think they break it out into escrow and prepaids, but it's still 15 months roughly that should be in there. And then you've got property taxes. And the property taxes are going to vary based on where you are, in that it depends on how often they're collected. In Texas, they're collected 1 year in arrears. So you're going to pay for December 20, the 2024 taxes, you're going to pay for those in December. So depending on when you buy, etc., you're going to have a different section of the closing disclosure that shows that the seller is giving you a credit for the portion of the year that they owned it. So let's say that you're closing on September 1st, the seller will pay 8 months worth of property taxes at their tax rate, and you'll be responsible for paying for the rest of the year, the balance of the year. So that is prepaid, and that you're going to start the escrow with that as well. And then the other prepaid can be a major one. And it varies on disclosures. It's kind of sometimes where people pencil whip it, and I say loan officers pencil whip it, because prepaid interest, particularly if it's a larger loan amount, that can be very significant. And if one of the loan officers is prepaying interest for 29 days, knowing that you're going to close on the 2nd, but the other one goes in and puts it as if you were going to close on the 30th, that can be a pretty big swing. So prepaid interest on it is a daily amount, and what it's there for is to square you up with the first of the month, because every loan that I've ever closed, you have to square up with the first of the month, and then you don't pay a payment for a month. So that helps to square it all up. In other words, most payments, and everyone I've ever been involved with, the payments were due on the first of the month. So you're paying for whatever portion that squares you up with the first, and that's prepaid interest. So those are the three big ones that I see in the prepaid department.
Well, let's go and throw the big wild card here that we're all very soon going to get to learn about is unless you've been living under a rock or you just don't pay attention to real estate much. And if you're watching this, you probably are paying attention to real estate because you're interested in buying or borrowing. Is this NAR settlement where sellers can no longer put in the multiple listing service what their cooperative compensation is, meaning how much they are going to pay to your agent. So, Gary, this is your area of expertise. Why don't you walk through that as much as we know today, historically, how that has worked and how this may impact what you need to be prepared for in cash at closing if you end up buying a property where the seller is not willing to pay cooperative compensation.
Absolutely. I wanted to mention one quick thing that I forgot on the EMD for the earnest money deposit is if you're listening to this right now and we just burst your bubble because you thought I was ready to get a home and I just don't have that 1% or that 3%. My encouragement, I know that everyone here would encourage this as well, have the conversation before putting the offer in. Ask your agent, say, hey, call the listing agent, tell them that we're really interested in the home. What else can we do? Can we shorten our time periods for inspections? Can we, try to improve our time periods of when we'll purchase the home. There's other terms that you can maybe negotiate to get around having that earnest money deposit. So I wrote that because I was like, gosh darn it, we didn't say anything about that. And I would just hate for somebody to feel like they couldn't get a home because they didn't have that amount of money, because it's very possible to get the home. You may just need to negotiate more on terms than you do on that earnest money. But getting back to your question, the fun one here. So as Josh said, there's a huge change that's taking place nationwide. And that is coming from the National Association of Realtors. And one of the things that's important to understand is that the National Association of Realtors is a trade organization. So they don't have any type of federal authority or any type of local state authority either. So you can think about it similarly to being a member of a country club, for example. So if you go to the country club, you have to abide by those country club's rules. And if, you know, they've got a certain dress code and Josh decides to show up there shirtless one day and in his Speedos because he's been watching the Olympics, they can say, Josh, you need to leave.
I swim much faster in the smaller swimsuit.
And they can say, you know, you're not following our guidelines, you need to leave. And Josh will say, oh, okay, well, that's good and well. There's another country club on the other side of town. I can join them, or I can just decide that country club life isn't for me, right? So it's very similar with the National Association of Realtors, where they've done an excellent job of making their brand, if you will, synonymous with real estate. And the majority of real estate agents in the country are a member of the National Association of Realtors, but not everyone. So the reason why I explain that is because this is going to differ state by state, area by area, MLS by MLS. Some MLS are owned either entirely or partially by the National Association of Realtors. Some MLSs have no affiliation at all, and they're not going to see a change, and they can still list their commission. So it's going to vary in a lot of different areas. So that's the first thing. So I want to just clarify that, is that you need to lean a little bit on your local expert, because how it applies in your area is going to be a little bit different than how it might apply in a different area. As Josh mentioned, I'm licensed in a couple different states in this, and they're completely different. They are so different on what I can and cannot do in each state and advertising and such. So that's the first thing. The second thing is, how is this going to personally affect you? So on August 10th, so that's the new date that we're being given by the VA, as effective August 10th, there's a temporary allowance. And we don't know how long this temporary allowance is. Temporary is in the name, we'll see what happens. But it's a temporary allowance where veterans can now pay real estate fees. That includes commissions, that includes administrative fees as well. Previously, those were disallowed. So a veteran could not pay either of those fees. Now, here's the key. That means you can pay it. It doesn't mean that you're required to pay it. So a seller may still offer a real estate commission to a buyer's agent. So they can still do that. But it just can't be advertised if you are in the jurisdiction of NAR, the National Association of Realtors. It can't be listed in the public MLS. And the public MLS is what feeds all these other sites like Zillow, Trulia, Redfin. All these sites, they're being fed by the MLS. So that's why you're going to see those fields disappearing. They've already disappeared, a lot of them, as a proactive measure. So what we're looking at here is you need to start having a conversation with your real estate agent as to, I understand there's a change. I understand that we don't exactly know how you're going to get paid, but what is your charge for your services? And frankly, what are your services? So you need to be able to start interviewing and dialing in what is it that your real estate agent and your real estate professional is going to be able to do for you. And there should be some variance in services. You know, there's going to be some that are a little bit more detailed in what they're going to be able to provide than others, just like in anywhere else that you go. You know, if you go to the doctor, you're going to have a doctor that's much more detailed than another doctor. And you can say, well, this one's more expensive, but they spent more time with me, but I prefer their care. Or I just want in and out. Get me in and out, get me my, prescription for my antibiotic, and let's call it a day. So you need to start asking those questions. You need to start interviewing more and not take it for granted, because there's a possibility that you may be responsible for paying this agent. So you're going to have those conversations up front, And you can, and in my opinion, this is just my opinion, you can, but you should communicate with your agent up front. On every offer that we write, I would like for you to attempt to negotiate your fee to be paid by the other party. That could still be done.
Gary, let me ask this. It raises the question, and I know it's going to be handled somewhat differently from state to state and board to board, but California, and I think most states, and it may just be a part of the settlement, you're required to have a written buyer's broker agreement in California before you even go out and show them that states what your expectation is to get paid, what you're going to do for it, and what are the ways that it can be paid. Is that all 50 states, or is that only state by state?
It's not all 50 states. California is taking the interpretation to the farthest end. And so in California, what they've done is they've eliminated what they call cooperating broker compensation, where other states haven't. And so it's a little bit different on how exactly that's looked at. But so what you're talking about now, this will apply across the board. So I'll kind of mention this so that you can have these conversations. It is something where the National Association of Realtors is requiring this. And again, if you're a part of that country club, you gotta play the rules. If you're not a part of the country club, you don't have to play by the rules. But they're saying there needs to be some type of formal agreement and understanding of what is your relationship to this particular buyer before you enter any house. So that's what Josh is referring to. So, and oftentimes it's referred to as a buyer representation agreement. And those can have all different types of terms. It could be a specific property, it could be a specific area, it could be a specific time frame, specific county, it could be a specific price range. And so the key in this is to make sure that you're reading and understanding and asking the questions of what am I binding myself to with this agreement? Right. I don't know if you've ever bought a car, you get excited. You ask the question of how do I turn on the hazards if I get in trouble? Right. You ask that question on the test drive, and how do I turn on the windshield wipers? And then they're like, okay, I got it. And then they hand you a book of things. They sign here, and then the car is yours. And you're like, okay, you just sign away, and you have no idea. Sometimes, at least I know that I've been guilty of this, of what you just signed on to. You don't want to do this in real estate because one of the unique things about this settlement, buyers, you could now be legally responsible to your real estate agent in a way that you weren't before, and your real estate agent could possibly sue you. That's kind of an interesting thing. That's one of the outcomes of this is that now there could be a contractual commitment that's made between you and an agent from the very beginning, whereas before it used to be, hey, I saw this house. Could you show it to me, please? Sure, I'll show it to you. There's maybe an implied agency, but now with that piece of paper, there's going to be specific obligations to one another. So make sure you understand it.
In the context of tonight's show, I think the important part is we're talking about how much cash do I need? I'm eligible for a 0 down loan. How much cash do I need? We don't know. None of us here know. It's getting rolled out into the open, and we're going to find out. I have a belief that things kind of bodies in motion tend to stay in motion. Things have been one way for so long that my belief is probably most sellers are going to want to not rock the boat and not try to figure out this brave new world where they can offer to not pay a commission. But some will. They'll be like, hey, I can save some money. I'm not doing this. So it's a conversation you have to have with your agent up front to know, hey, if we come across one of those houses and I fall in love with one that's owned by a seller that says, absolutely not, I'm not paying your agent. How do we operate? How do we move forward? And you have that discussion up front, because in the context of tonight's conversation, how much cash do I have to be prepared with? What can I do? How can I do that? So I think we've covered all the major pieces of closing costs, including the potential for having a realtor's commission being a closing cost. We covered prepaids. So Stephanie, this is one of our favorite things that comes up in the Vetted VA group all of the time. Someone says, I'm eligible for a 0 down VA loan. I have no other money. How do I roll my closing costs into my loan? And the Vetted pros will always start the answer that you're going to give here. And we will always have people adamantly say, I have always rolled my closing costs into my VA loan. There's always, I would say, people always say there's always one. There's not always one. There's usually 2 or 3 that want to debate and argue and tell you that they have done this, even though the VA does not allow you to roll your closing costs into the loan. Can you explain that big picture of what it looks like to anyone watching tonight's show of potential ways of getting those closing costs and prepaids covered if you don't have them yourself?
Yeah. Well, it also goes back to, I think the foundation of vetted VA, right? And that is education and understanding the loan, the fees in the loan, and the correct terminology. And so when we see these comments in vetted VA about people, oh yes, I've rolled all my closing costs in for all my loans before, it makes me think they didn't have a true understanding of a fee sheet or their loan estimate. And so we're going to go back to understanding what that is and what the VA allows. There's only a couple ways you can get your closing costs covered and truly have zero cash to close at that very bottom of the loan estimate or the closing disclosure. And those ways are through a seller credit, right? The seller gives funds, and let's say your closing costs are your final cash to close and all the closing costs. Let's just assume you're not paying anything for a rate. Let's say all those closing costs that we mentioned before, appraisal, title fees, all that. Let's say that all adds up to $10,000. And your cash to close at the end is also $10,000. Let's just assume you didn't put let's say you put $1,000 earnest money deposit. So now we're minusing $1,000 from your $10,000. It's $9,000 cash to close that you're going to need to write a check at the end. But let's say the seller is giving you some seller credit, $5,000. Now you're down to $4,000 cash to close. So seller credit is one way you can get, lower cash to close. And let's say for that rate, let's just assume that the rate is you got a lender credit for $4,000. Now you have zero cash to close. So the only ways you can really get your cash to close to zero, again, lender credit, seller credit, a refund of your earnest money deposit. Where we see people argue that they are sure that they had it all covered, either they didn't understand that there were credits given, right? It wasn't properly explained. Or the only other way is, let's say you have the property, you put an offer at $500,000 and the appraisal comes back at $510,000. At that time, you can negotiate with the seller to increase the purchase price. And now they're going to give you a seller credit of $10,000 that's going to cover those closing costs. So it's not technically rolled into the loan. It's technically the seller's giving you credit.
And only if the value supports it. That's the important part,
Yes.
is whether you negotiate it up front or after the appraisal comes in high. If the appraisal doesn't support it, it cannot be done.
Yeah.
Because the way the VA looks at it, you're not required to put any money down, so you're getting 100%. If you are required to pay a funding fee, that can be financed into the loan. So we're greater than 100% financing. But if you have another 2.5% of costs and a 215 funding fee, they're not going to do 104, 105% loan. It's just not there. But if the appraisal supports it and the seller's willing to credit you, cool, absolutely good with that. If we can bump the interest rate up, not the loan amount, because that again would push us the same thing, too high on the loan to value. If we can bump your interest rate and the lender says, well, cool, we're going to get an extra 0.5% of interest, so here's 2% to use towards your closing costs. All of those things are good. And to a borrower, it can be perceived as I rolled them into the loan. They weren't rolled into the loan. The loan didn't grow. You either took a higher interest rate or you paid a higher price that was supported by the appraised value, and therefore you didn't have to come in with money. So absolutely possible to come in with zero money at closing and even get a refund back of your deposit and even get some of your debts paid off if you have a really generous seller with a solid appraisal. So again, the VA is the absolute king of all types of loans. We have flexibilities we don't have any other way, but it's not truly just rolled into the loan. Now, let's talk about a couple of costs that are unique, and VA is unique among one of those unique ones. And Randy, that's the appraisal. On other types of loans, we generally get that paid up front because the appraiser doesn't want to go out and inspect that home until they have been paid. VA is a little bit different. How does the VA appraisal fee work, and is that collected at closing? Do you have to pay it up front? What does that look like?
It really depends on the person. There's not really a good system in place with any of the lenders that I deal with to collect up front. And so in my case, and I can't speak for everybody, but in my case, I front that and then put it on the closing disclosure. And I always let my people know if there's some issue that you decide not to do it after the appraisal has been paid for it, that's still on you. And so that's the case where that recently had one where that everything was fine, everything got to almost to closing, and valuation came in a little bit short, and the borrower just decided they didn't want to do the deal. She had to pay for the appraisal, but it was something where that we paid for it, and then she reimbursed us for it. So most of the time, like I said, there's not a real good vehicle in place like there is for FHA and conventional, et cetera, in my lenders. And so we foot that bill, and then the borrower pays it at closing.
Absolutely. And it's just, again, it's different than other loan programs because we order it through the VA. The VA assigns the appraiser, and the appraiser does go out and do the report without getting paid. They put the invoice in, and we're the ones on the hook. If we stiff them, then the VA goes, hey, you're a jerk and you don't get to do VA loans anymore. None of us want to do that. So it's a little bit different in that the VA knows no one's going to stiff an appraiser because you don't want to lose the ability to do VA loans. So the appraisers always get paid. But by the time we get it, it's usually so late in the process that to try and tell the borrower, hey, send them a $700 check, or other parts of the country even more expensive, it's just a different process. So most of the time with the VA, you're not going to have to worry about the appraisal upfront, where with other loan types you would. Gary, on your side, this isn't the only one, but I'm going to ask, is what are the things that a buyer needs to be prepared on the real estate side to pay prior to closing and also have funds available for?
Sure. The number one thing is going to be your inspections. Now, again, the majority of inspections are going to be more buyer beware, meaning that they're going to be optional. But it's, in my opinion, that's going to be one area where you want to be able to invest as heavily as possible. Because the better information you get about the home up front, the more you know what you're getting into. There's no such thing as a perfect home, new builds included. They're not perfect. They're going to have different challenges, with them. And so if you have a competent home inspector, you could have a HVAC person, electrician, pool person, you name it. Any of these home related trades could go in and do a specific service for you as an inspection, but that's something that has to be paid at the time of service, if not in advance before. So that's going to be the major thing that you're going to need to be prepared for, and those are not refundable. So keep that in mind as well. And sometimes I'll see in vetted VA people get a little upset about that, just in the sense of they say, "Gosh, I paid $500 for this home inspection, and we found out that there was a sinkhole under the master bathtub, and now we don't want the house anymore. Like I want, and I still had to pay the guy." And it's like, well, from their perspective, the inspector said, "You hired me to give you a thorough inspection and a thorough report, and I did that. So my job's done. You decided to move on to a different house, and now you want an inspection on that house, and so you're welcome to hire me or someone else, but my service is done." So that's something just to be aware of, is that if you decide that house isn't for you, then that expense is going to come up again for any inspection that you might want to have done.
Seems like the best $500 you could spend right there in that scenario.
Absolutely.
Legit. Here's an example. This was a conventional loan. It wasn't VA, but a borrower here in San Diego ended up paying $650 for his appraisal because we had a very short timeline on when he was required to get his appraisal. And he paid $500 for an inspection, $1,150 into it. And he finds out major plumbing issues. So they call a couple of plumbers out to give him bids. One was $30,000. One was $40,000. So $1,150 for something that could have been $30,000 to $40,000. And they go back to the seller and they go, "Hey, there's a major problem." And two plumbers agreed. It wasn't one plumber trying to stick them. The first was 30. The second one came out and said 40 to fix this. And they went back to the seller, said, we would be okay with 30. We have someone who's willing to fix it. And they go, "No, we'll give you 5. They walked. So they walked away from $1,150 to not walk into a $25,000 to $30,000 problem. So it is an ounce of prevention is better than a pound of cure in that situation. So Guys, we got a question here, and it's a long question, so I'm trying to get everything here. But Crypto Roger is watching. He says, "Timely video. Looking into my situation to buy a house. I'm 100% VA rated. Says my certificate of eligibility says 35,000. How does that get me a house?" It says correction 36,000, which is correct. So we'll talk a little bit about that of why does your certificate of eligibility say you have $36,000 of entitlement, and we're talking about buying $400,000, $500,000, $800,000 houses. Then he follows up and says, "I've got 16,000 in cash, 4,000 a month in income from the VA. Wife makes 3,000 per month too, and I want to sell my existing house, mobile home." Not sure that's super relevant to the majority of the question. So the crux of the matter is, if my certificate of eligibility says 36,000, how do I buy a house for 240? Stephanie, you want to take a stab at explaining why the $36,000 of entitlement can get you $1 million or $2 million house?
Yeah. Well, first of all, we have two different things we're considering here. We have entitlement, but we also have qualifying for the actual loan amount. So let's look at entitlement. Your COE says, your certificate of eligibility says you have 36,000 in entitlement. That is actually full entitlement. So that means if you are income eligible and credit eligible, you could possibly buy a $2 or $3 million house for if you have full entitlement. Now, the second part is income and credit qualification. And just by you putting the income in there, we're not going to be able to work that out for you at this moment, but it is possible with that entitlement that you could purchase that amount of home. Again, this is where it's really important to talk to a loan officer about your specific situation, because one thing we can't see on here is like your credit, do you have any debts, that kind of thing, but it's definitely possible.
One of the big things to factor in that he mentioned is he's 100% rated, and in Texas, that means no property taxes. So that boosts his buying power in a big way if he's working with the right lenders.
Well, okay, Randy, let me ask you that question, because the gentleman I was talking to earlier today in Texas, I was like, hey, I got to go back and check. I know we were working on several states where you get a reduction or an exemption from taxes from being able to use that to qualify at closing. But are you in Texas? If you're 100% permanent total and you're not going to have to pay property taxes, are you able to use that as a loan officer when you're qualifying that person to purchase, or do they get that benefit later down the line after they buy?
The standard thing is for it to be later, but the thing about that is that there's no reason for it to be that way. And every lender that I deal with I've had to fight battles at each and every one of them, but they allow it to be used to qualify and to close. The big thing there is to remember what we talked about earlier, in that the prorations are going to be given as a credit at closing. So even though you don't have an escrow account, you're going to be responsible to pay the prorated portion later in the year. And so that's a big thing that you can even run into glitches with the title company that's not willing. I just had that issue this last week, but that's the first time ever that a title company was adamant on this. But the lenders, if you use them, and you're closing in Texas, I can tell you the ones to use where the battle's already been won. So
perfect, and that's important for my guy. We're talking about earlier today, $834,000. It's a lot of taxes. Most of Texas is over 2%. We're talking $1,500 a month in his situation that he won't be responsible for, but he's being underwritten as if he is. And more importantly, those prepaids we talked about at closing, he's going to be bringing those in unless he gets with a lender who will use the exemption.
But in winning that battle, the important fact is that the exemption is 100% and it's available at closing. In other words, as soon as he owns the property, it's available. So it's not like there's some sort of, you got to wait and be in the house in January, those sort of things. It's an immediate award. And so if you put together all the tax codes and whatever, if you have any issues whatsoever, I'll help you get that thing done. Absolutely.
Perfect. I love it. One last thing to point out, Roger, here, if you're still watching, your $4,000 a month in disability income, it's not taxed. We can gross it up. You're going to get extra credit for that. So it's as if you made more money, because if you went and had a job, you'd have to make a lot more than $4,000 to have $4,000 spendable. So we will make an allowance for that and
I think there was a
increase
third
it for
part too of Crypto Roger's question, and that is the amount he has in cash, 60,000 in cash. Is he able to, we go back to that, what is the minimum amount you need to buy a home with a VA loan? And, we talked about that before, right? So inspection, 350 to 600, and earnest money deposit. That would be the absolute minimum you would need in cash, right, to start. So it is possible with that 16,000.
And even with
comment on that too, of just saying for Crypto Roger, anyone else that's listening, that part where you had the cash is like, oh, this is a good point. I highly recommend connecting with your loan officer before you do anything with the cash, because I get a lot of people that will call me and be like, oh, I'm cleaning up my credit. I have 4 different cards. I just paid off one and I don't have the money to pay off the other 3. I'm like, wait. Because there may be a different strategy where we can help you to get into a different position to qualify you in a better scenario than that. So if you have some cash, it always is an advantage to connect with someone, so they might be able to give you some coaching on how to best use that cash to your advantage.
Especially if Crypto Roger has that all sitting over in crypto, that can absolutely complicate it a little bit.
That's true.
Well, and the real estate agent doesn't always know what that strategy is. The loan officer knows the full financial picture and then can work with you and your agent. But just going to the agent and saying, I have 16,000, they're not going to know what they need to do with that. So that's why it's really important that you establish that team and that you do talk to a loan officer early.
Yeah, start that relationship up front, because like you said, with the crypto, there's some instances where some lenders are going to want you to season that in your bank account, and then there's other issues that they can come into play where like Gary said, you might need to pay something off, but you might not need to. I find that more often than not, where the people think they have to have everything perfect, and they think they have to have a perfect score, et cetera, and then it's not important at all to their situation. And if they take those actions without the consultation and the relationship, they can really push their timeline back. So start that relationship up front with a trusted loan officer that's really VA focused and VA experienced and passionate, and then find the same person in the realtor world where that you find someone that's passionate and knowledgeable about the VA, and your team is going to help you be successful.
We did an episode on that too. So go back to the archives, and we have a whole episode on how to pick your pros, what you should be looking for, what you should be asking them as you're doing your vetting. So all of us here have been vetted by a vetted VA. You still need to do your own vetting and make sure you're getting the right people for you. Stephanie, we just talked about crypto. We talked about Roger having 16,000, how you're going to allocate that money. Let's say that someone doesn't have money and we're not getting a seller credit. We don't have lender credit. What are some of the other potential ways someone could source money, whether it's all or a portion of the funds that are required?
So gift funds, right, can be from a family member. We do need a letter, and that's not something you want to just, spring on everybody during the transaction. That's something that you're going to have the conversation with a loan officer ahead of time, and they can help you manage the gift fund process, because there's a little bit of a process. There's some documentation that we need. That initial deposit, it does need to go to escrow in cash. It can be wired, right? Some lenders will allow the gift funds and some won't. So that's just, you got to be careful about that. And then, your inspection, you usually can pay with a credit card. So you gotta, again, the reason why to talk to a seasoned loan officer ahead of time is to plan this and not have it be a last minute thing that you're trying to figure out. So that's my 2 cents on that. Sorry,
one other thing on Roger's situation is that you can actually use the real estate owned expected proceeds as an asset. And it's because a lot of people don't understand that you can sell your property on Monday and buy your new property on Monday if everything works out the way it can, using the proceeds being wired from one title company to another, or even closing at the same title company if that's ideal, depending on how it is. But real estate pros, in other words, if that house is going to sell for $100,000 and you owe 30 on it, then you're going to get 50 grand in proceeds that can be used to cover whatever you need.
Well, Randy, you bring up a really good point. So he said it's a mobile home. If it's a mobile home and it's not permanently affixed to the land, it's not real estate. It's not selling a house. So let's say it's not real estate. If it's an asset, he owns it. He's going to sell it. We can document that. Is he able to use those proceeds? And then are there other types of assets that we can sell and use those proceeds?
So now we get into a whole nother can of worms when Josh opened that one, because if like I've had people use, a quarter horse sale and document it, et cetera, and use those proceeds. But there were more hoops to jump through.
Several more hoops. What are the hoops? What do you have to prove in that situation? Use the quarter horse example. What do we have to prove?
In the quarter horse example, we had to prove that he existed, that he was registered, and we had to have him appraised that as being worth that. And then ultimately we had to have a third party proof that the sale actually happened. So there's all sorts of extra hoops there that you don't get into, on real estate owned. But I've had the same thing with jewelry before, where people wanted to use that. Same thing. You had to go through the appraisal process, et cetera. And it's just going to depend on the particular lender and even the particular underwriter as to how many hoops they want to make you jump through. So back to what we said earlier, get that relationship with the loan officer early and season that stuff for, when you got the major hoops, season it first, so you don't have to, it can be in there for 2 months, whether it just chose to be there, then no hoops.
And that goes for the mattress money too, right?
Exactly.
Yeah.
Exactly.
Yep. So lots of different things there. And the funny thing is the stuff that's owned, people are, well, I have this asset. And beauty is in the eye of the beholder, because almost every time, whatever the asset is, quarter horse, it's a donkey and someone tells me it's a quarter horse. It's a classic hot rod and it's a 72 Pinto with a fully blown engine. And you're like, I don't know that that's a hot rod or a classic, either one. So we do have to document that it's really worth it. It's not just a way of laundering money for the purposes of the mortgage. We actually have to show that you own the asset and that it is worth what we're saying you sold it for. Your brother paying you $10,000 for that Pinto doesn't mean it was actually worth $10,000. So with that, Gary, anything else that you think in terms of from the real estate side that when you're talking to someone, they should be prepared to have at closing or through the process?
Yeah, so I just had a couple thoughts, actually. So first is kind of jumping off of what Stephanie was sharing. I know we've talked a lot about earnest money, which I don't think we were planning on doing, but that's been good. It's a good conversation. It's an important part of the equation. And one of the questions that we get in vetted VA quite often, I think I got it last week, actually, as the most recent, is, will my earnest money be held, or is someone going to cash the check or take that money now? It needs to be liquid. Right. So it's not, oh, I'm getting paid next month, or I'm going to write you the check and you can hold on to it, and if something happens, you can cash it. No, the moment that earnest money is leaving your possession, assume that it's going into a separate account, and that account is going to be held by a third party until there's instructions as to what to do with those funds. So those instructions are going to come either at the cancellation or the completion of the contract. But just know that make sure that it's going to clear your account, and your loan officer is going to come back and say, hey, did that clear? We good? Like, sometimes there's going to be a condition even from underwriting wanting to see, this is cleared as well. So it's something that's important to be able to know that you need to have that day one so that you're ready to go on that. The second thing that I would recommend, and this is a personal recommendation as we start navigating all of these National Association of Realtor transitions, is this. I would highly recommend, and if you're in the market, write this down so you don't forget it, forward your broker representation agreement to your loan officer, because your loan officer is going to receive your purchase agreement But if I was working the loan for a client, I might not know that you agreed to paying X amount. So let's say, for example, that you agreed to have a 3% payment to your agent, and the seller is giving you $5,000, but 3% of the purchase price is actually going to be $8,000. So I need to figure out, where's that extra spread coming from? Because you may be obligated for part of that. So I just recommend getting to the habit, because this hasn't been the case previously, of saying if there's a buyer representation agreement, to get that over to your loan officer so that he or she is fully aware of your entire financial situation. That's their job, but they can't be held accountable for not having all the information. So that would be my last thought on that, is just forward that over to them so that they can have the full picture, because real estate agents aren't going to think about that right away, because that's never been the case, to say, oh yeah, let's do this as a standard practice. So you might need to just help them along in this transition for both parties, because loan officers also don't normally ask, can you do you have a buyer representation agreement? Can you forward it over to me so I can see how that's structured? So this is just a transition piece.
Absolutely. Great information. Under the banner of Vetted VA, there's a lot of things we do, and the live show here is one of the things that has one of the smaller audiences. And the crazy thing is, I think it is not just because I host it; it's because of the experts showing up here in the conversations we get to have. I think it's one of the most valuable. It's not answering a question and getting one direct answer, because like when we outlined this tonight, I always do the outline. I send it out to the pros. Say, hey, what else should we throw in here? And they'll throw a few things in there, and we're like, we got it. And then you get here 4 people with probably 100+ years of experience of doing this stuff. All these little things come out, and even Roger piping in with those questions, and you start asking and answering the questions, more things come up, and you start to see all the nuance of it and the things that you can or should be aware of, or at least why you need to be working with pros that really have your back and really know the ins and outs of these guidelines, so they can cover you from beginning to the end. So we're at 57 minutes right now. We like to keep these to about an hour, but I always like to give everyone one last shot to share any final words of wisdom on tonight's topic, or not, just anything. So Stephanie, we're going to go ladies first. Anything that we didn't cover tonight that you think is just important that you'd like people to know about the market in general, or maybe the specific current market that we're going through with rates decreasing?
I think the one thing we didn't talk about was the costs involved with military moves. I know that's a whole nother topic, but it does play a little bit into the amount of money that you have for a transaction, right? So that's why it's really important to talk with the loan officer if you're going to be PCSing, I think at least 3 months before you PCS, so that they can make a plan, because part of the plan is, how are you paying for that PCS? Right? Some branches are going to make you pay for the hotel yourself upfront, the cost and all that. And some are going to let you use a card. So you need to know what cash you need and where is that cash coming from. And then at the same time, you're putting an offer in and you need earnest money deposit. So there's, let your team help you with the strategy, but they need the information, and they need it, I would say, a few months ahead of time. That would be my last comment.
Great advice. A great comment. Randy, well, you got any final thoughts for us?
Well, the biggest thing that we didn't touch on was the funding fee, and specifically the fact that you can roll it into the closing. You don't have to bring that in cash to close. And then the other part of that is you can be exempt for just having a 10% rating. And so I would just encourage everybody to make sure that you're working on your rating, because one of the natural things to do when you walk away from the military is to say, I'm walking away from the military and I don't want to mess with that kind of stuff. But that 10% will save you some significant money. And really the tinnitus can get you there every time if you answer the questions right. So 10% can end up being, saving you 3.3% of the loan amount on a funding fee. So there's my last little gem.
Great info. Gary, what do you got for us?
The VA guaranteed loan is the best loan by far, and we have the data to prove that. And the reason why I share that as the last thing that I'll say is because I hope that will bring you hope. If you feel like home ownership is not in my future, That's probably not the case. If you are entitled to a veteran guaranteed loan, a VA guaranteed loan, it's possible. So connect with one of us so that we can help you and get a plan together. Like home ownership definitely is possible for most people.
Absolutely. And sort of putting a bow on tonight's show is Stephanie said, never too early to start, get ahead of it. So there's things that are specific to your location. You know, I lend in probably close to 10 different states. It's different. The numbers are going to be different. You'd be buying the same $500,000, 1,500 square foot home in two different states. Those numbers look very, very different. So you need to get ahead of it. Get those numbers laid out for you. Go through that conversation. What are all the ways that you could pay for this? Of those ways that you could pay for it, what are actual options for you? So start early, pick a team of pros, including your realtor, because they can be involved in this numbers conversation up front, especially in light of potentially you needing to cover a portion of their commission or all of it. So hope you guys found value tonight. Appreciate the three of you joining us and sharing all of your knowledge. Appreciate those of you watching. Appreciate Roger for asking some great questions tonight and further in our discussion. So we'll be back next week with another group of vetted pros. Thanks for joining us tonight, everybody.
Everybody.